up, and welcome back, everyone, to another episode of the Practical Planner Podcast. I'm your co-host, Thomas Kopelman, here with me, Dave Haughton. Dave, how you doing today, man?
Great. How you doing?
I'm good, man. I'm good. A little, I would say, just desensitized to everything going on in the markets today. So I'm really excited, though, to talk about the topic today. So obviously, topic today is going to be all about, what to think about estate planning wise while markets are down. But I think for all the listeners to know, we're recording on the 9th. And we're recording about 10 minutes after Trump actually decided on this 90-day tariff pause. So this last week has obviously been very volatile, very weird, right? We saw, 3 trading days in a row that, I think top 3 all time fastest decline in history. We saw a fake news story on the pause. Markets went up about 7% in 30 minutes. Found out it was fake. Markets went back down today, found out now it's actually true. And in that period of time, in the last 10 to 30 minutes, now we have QQQ up 10%, S&P 500 up almost 8%, Bitcoin up almost 7%. So we're seeing the markets almost respond like crypto at this point. And, we have no idea what the markets are going to look like next week when this happens. But I don't think that changes this topic and how we should be educating advisors about what to think about when markets are down. And because down markets create different opportunities. And, I'm curious for you, you worked in an RIA, you helped advisors think about planning. When markets were down, what first went to your mind, and what were you guys talking to clients about of how to take advantage of this opportunity?
Yeah, I think oddly enough, from an estate planning perspective, a lot of times when markets are down, it represents actually an opportunity, because from an estate planning perspective, especially when it comes to estate tax planning, the idea is to get assets out of the estate at the most discounted rate you can, at the lowest value you can, and have them grow outside of the estate. So for example, if you can get an asset into a spousal lifetime access trust, into an intentionally defective grantor trust that's outside of the estate, and you make that gift, and let's say that gift is of stock or a brokerage account, it's $5 million. And then after you make the gift, you use up your estate tax exemption up to that $5 million. If it then thereafter grows to be $20 million, now that's all grown outside of the estate and hasn't affected your estate tax exemption, because you made that initial $5 million gift. Everything happened outside of the estate. So it can be a tremendous opportunity. Obviously, there's risk. There's not only legislative risk. We don't know what's going to happen with the tax law. We don't know if there's going to be an estate tax repeal. We don't know if the Tax Cuts and Jobs Act is going to sunset. We think maybe it's probably not going to, and the estate tax exemption will keep inflating. So there's risk there, because if you gift assets out of your estate, even if you think they're going to grow, but then the estate tax exemption stays high, then you're in a situation where you're going to lose a step up in basis. So there's risk there legislatively. Obviously, as you know, there's also market risk there. You have to be confident to think that this is actually down and it's going to grow, and it's not just going to keep going down. That's another thing to think about, but definitely represents an interesting opportunity to think about.
Yeah, I think we take away the side of like, oh, what happens to estate taxes in the future? Like, we're looking at this through the lens of like, okay, we think that you're gonna have an estate tax issue and we want to plan for that. And so planning for that, right? I think you made a few good points. I think one of them is, you want to use assets that are actually have gone down in this opportunity, right? So like there are parts of the market that have not gone down, typically areas that just, tariffs wouldn't affect. But in general, if you see something go down, it's an opportunity to get more out of your estate using less exemption, right? So I'm thinking about, I have a client and, their parents have used most of the exemption. They only have a little bit left. Well, let's say you only have $2 or $3 million left. You're going to get significantly more shares of stock over when the market is down 20, 30%, for example. I still think you want to pair this with high growth assets, right? Like you're not going to be like, okay, let's move something over that's down 5% when we think the growth is going to be minimal, because if there's minimal growth, you're not getting much out of your estate and you're not avoiding much in estate taxes. I think the second good point you made is don't just put something in because it's down, right? Because let's say you own terrible individual stock, it's down 55% today, and you're like, great, I can move all of it there. But that's an investment you wouldn't really want to even own long-term. If it's not going to grow, it's not going to be beneficial, right? Like you really are just trying to get growth out of your estate. I think those are probably two of the most impactful things. I think when we think about this practically, though, how do you do this? Because it's not as simple as like markets down 20%, estate planning attorney, drop me a slat, great, documents are done. Hopefully now I have the opportunity to get it. Like when you guys are helping people do this in practice, is this, we already have these trusts set up? Because what I see in practice a lot of times is people do set these up. They don't always max fund them right away. There are different times where we're like, hey, we're opening up the tool so it's available. There's also times where people just drag their feet, right? We see it all the time. They maybe got something set up and then they're like, oh, I'll think about it later.
Yeah, absolutely. I mean, certainly that's important to understand is this takes time. And this is a very, very hot time for estate planning. We have the great wealth transfer. Estate planning attorneys are busy. They have plenty of clients. They're not starved for business. So if someone calls and says they need a SLAT or whatever the GRAT, whatever the case is, some kind of wealth transfer tool because of where the market is, the likelihood that they're going to be able to quickly turn around, get that trust in place, and then be able to move the assets in kind over to that trust while the market is still down, I'm not sure, how likely that is. And so it is important to understand that you need some runway with this. It's not something that you can do on the fly if you have no documents in place. We had all this going on over the past few years where there were years ago, it was thought that potentially grantor trusts, or even recently, actually, with the recent election, depending on how it went, people were concerned that grantor trusts were no longer going to be an option for individuals. And so what people were doing is they were saying, well, at least create one. Just get one in place as a standby so that when the opportunity presents itself, you can fund it. And that's even happening now with the potential sunset of the Tax Cuts and Jobs Act, because a lot of people want to get assets out of their estate before it sunsets. The issue is we don't think it's going to sunset. We don't know that. So there's a lot of unknowns. So it can be good to at least get some kind of trust in place as a standby to be able to fund it, even if you're not going to max fund it yet, because later on that transfer vehicle is still going to be valid later on, and it's something you can move assets into pretty easily without needing to coordinate with the attorney and all the time that could potentially take to get it in place.
Yeah, and I think a GRAT is a really good tool to think about in today's environment, right? So whether, I recently did a financial plan for a client that's a little over 30 million net worth. And, one thing that he was talking about is, I don't know how much estate tax planning I want to do today. We're thinking about Roth conversions, terrible time for Roth, great time for Roth conversions is down markets. But he was thinking about like, hey, I want to start getting a little money to my kids. What if estate tax threshold gets cut down, spouse passes away, et cetera. I want to do some things today. GRATs are a good opportunity for that, or people who have already used the exemption to say, hey, let's start a GRAT when the market's down, right? Because it's all about growth and beating that hurdle rate. And so typically, if you look at what happens in stock market, 1, 2, 3, 4 years post, recessions, if you want to call it a recession, we're at really a bear market, that does create a really good opportunity to potentially get a lot of growth out without using any estate exemption.
Yeah, absolutely. As we talked about, there's risk there, right? Is it going to beat that hurdle rate when, the 75-20 rate is potentially high?
Well, the downside is that bad, right? The downside of a GRAT is, we just really didn't get anything out. We still own the investment. It still goes back to us. So, at least the downside is, maybe shoot for it, right?
That's exactly right. There's not a lot of downside to a GRAT. Obviously, the downside is, attorney's fees and complexity and getting all that done. But to the extent that, you feel, obviously you don't want to do it like as a complete, just throwing it against the wall, hoping something's great. I mean, I guess you could, but you want to at least have an expectation that you're going to be able to beat that hurdle rate and there's going to be some upside to it. But definitely in a down market, that makes a lot of sense. In a low interest rate environment, it makes a lot of sense as well. So these are times, when the economy's in interesting time periods where it's down market or the interest rates are low. Those are when you're looking for these opportunities to get assets out of the estate so that you can utilize some of these transfer vehicles.
And, if you're watching the 10-year, curve, like, the rates are not going down. They've actually been the opposite, went down for a day. Now they're back up. And the interesting thing about that is I think staying on top of that is also an opportunity as well. So if that creates opportunities over time, that might be better, for your family to do loans, right? Hey, can I help my kids get a mortgage? Can they borrow from me? Are there other things that we can do as rates drop, because those AFR rates drop as well? But not necessarily. I think a lot of people look and say, well, hey, if the market starts doing bad, then all of a sudden they're going to drop rates. But that doesn't necessarily mean long-term rates drop, which doesn't mean borrowing rates drop. So these are things as an advisor, right, you can stay on top of. We can't predict where it's going, but as they happen, hey, down market, great time to gift stock, right? It also can be, business valuations go down typically in this period of time too. So I'm thinking about, I have a client right now who they're passing the business from dad all the way down to kids. Well, if they have a business that brings in a lot from China, I'll tell you the valuation of that business is probably going down a lot, because you're thinking about increased cost of goods. You're talking about reduced profits. Hey, can we get money moved over in this opportunistic period of time where there's so much uncertainty as well?
Yeah, absolutely. Yeah, and I think, the other thing is that's really important, and I talk about this a lot, is we don't know what's going to happen. So it's just really critical that you have flexibility. So we talked about, getting those documents in place potentially to be able to fund if you think the time is right because you have it in place. The other thing is making sure that you have the right, even revocable trust documents, the right power of attorney in place. Because what if something happens and you become incapacitated? You want to have someone to have the opportunity to be able to take advantage of some of these opportunities on your behalf. And if you don't have the right documents in place, you haven't given them the right powers, and, estate tax mitigation and trying to preserve as much wealth as possible is a big priority for you. If you haven't got these documents in place that's given your next person in line, whether it be a spouse, child, whoever the fiduciary is, to have the opportunity to be able to take advantage of some of these things, because we don't know what's going to happen, now you're going to be in a worse position and they're going to be kind of stuck. So you really need to think about two things. You need to think about, how can I take advantage of the opportunity now by doing transfers and utilizing what's available now, but also making sure that my documents are flexible enough that if something happens to me, my fiduciary is going to be able to take advantage of that for me.
Yeah. Yeah. Really good points. I think, the other place that my mind goes in this is maybe a little outside. Maybe I guess this is still in the estate planning realm of some of these, but down markets create good opportunities for certain things, right? So if we think about up markets are a great time to do, charitable giving. You can donate more, get it, use less stock. You can get a larger deduction against your income. Down markets are less about that. They're more about gifting. They're about Roth conversions. And I think Roth conversions is one I've seen more people talk about recently, but it's a really good opportunity. Sometimes people are like, hey, I don't want to, do too much in Roth conversions, that I'll move from 24 to 32. But you're like, I had somebody reach out to me. They're like, how am I supposed to do this by myself? Like, what happens if I hit 32? If you have 10,000 extra hit 32, I mean, you paid $800 more in tax than if you did 24% bracket. So not that impactful, but right now down markets create the ability to, like, let's say you had 100,000 of room before, that's now down 20%. You can either do that same amount for 80,000, or you could effectively get an added almost 20% more stock converted by filling that amount, which is also a good tax planning tool, right? A lot of what you talk about with older clients is, you have a lot of money in pre-tax. You are in a lower bracket than what your kids are going to be when they inherit this money. Should we be thinking about Roth conversions? And that still minimizes not estate taxes, but more so maximizes total wealth preserved in your family.
Yeah, I talk about this often, and it's timely because the Masters is this weekend, and I talk about, when golfing, one of the big concepts is a good miss, right? You're shooting for a target, but if you don't hit that target, you're still going to land in a safe area. And I think that's the way that Roth conversions potentially work, right? Is there's still, like, even if it doesn't work out exactly how you planned, how you're projecting the reason you're doing it, you're still probably going to end up in an okay position, because now you've converted it over into be tax-free. Beneficiaries usually have to take it out within 10 years after death. And if they were inheriting it and it was pre-tax, they'd have to realize all those taxes over a 10-year period. Whereas if it's in a Roth, they still have to take it out within 10 years, but they could let it grow until year 10 and then withdraw it all and have all that growth be tax free, which in itself might have been a great reason to do the Roth conversion. So I just think it's such a great opportunity for that.
It's funny you say that because in like the XY planning group today, somebody was like, hey, CPA told my client that they have inherited Roth IRA and they need to take yearly RMDs. And all these CPAs came in and was like, yes, you have an RMD, take it out every 10 years. But that's actually not true. With Roth inherited accounts, you don't need to take a yearly RMD. Roth accounts are not even subject to RMDs. You have a 10-year period. In most periods of time, right, if you don't need that money, let it grow 10 years tax-free, right? At a 7% rate of return, that's over another double tax-free.
Right.
You typically want to use that.
Right. And yeah, and a lot of people don't realize that, like, a lot of the pre-tax IRAs, they have these new rules with the Secure Act that you need to take this RMD. It all needs to be withdrawn within 10 years. It doesn't necessarily mean 1/10. It's still according to life expectancy. But it's according to rules related to pre-tax IRAs. So the Roth shouldn't apply to that. You should be able to keep it in that Roth for 10 years if you want to.
Yep, exactly. Okay, cool. Anything that we haven't talked about as it relates to utilizing down markets with estate planning and financial planning?
Yeah, no. I think we covered most of it. I think it's just really important to look at the landscape and look at what risks are there. Certainly not jump into anything just because you see an opportunity. Make sure that you understand comprehensively all the pros and cons. It definitely represents an opportunity, but on the other side, there are risks. So you just got to be really careful.
Yeah, completely agree. Okay, well, I think this was a really timely one. Everybody, we appreciate you listening. Again, this is all just educational purposes for you. Like, we can have all these tools, we can think about them, but one client versus the other might be doing exactly different things. So really take this, apply it to your client's life. But everybody, thank you for listening. We really appreciate it. If you have any questions, feel free to send them to us. I think this year we're going to try to do a few episodes where we're just kind of hitting on topics that advisors are sending to us. But remember, rate, subscribe, and we will see you back next week.